Okay. So online students also can hear me. Can you respond? Can you hear me? So we go to the activity. First one. The company issued new shares to the market at a price of 100, right? So last week, just to recall our memory, we have identified 4 components of the finance. What those 4 main areas are. Shakti, absent today? No. Right. First part, introduction to finance. Introduction to finance, and then we identified what? Second one, introduction to finance, and then main areas in finance, main areas. Main areas in finance, there are 7 main areas. And then we move to the main decisions in finance, right? Main decisions. Main decisions in finance within line to the role of the finance manager. Role of the finance manager, FN. Right. So under the role of finance manager, in line with the decisions, we identified 4 decisions. So these activities based on that 4 decisions, right? Okay. First one, company issued shares at a market price of 100 rupees. What kind of a decision this is? Yes? Capital financing decision. That means capital structure decision, right? Capital structure decision. This is capital structure decision. Capital structure decision, same name, financing decision. Financing decision. Second one, GEM PLC software company decided to introduce a new computer system. New computer system. What sort of a decision this is? Yes, very good. That is an investment decision. Investment decision. Or else we have other name. What is it? Capital budgeting decision. Capital budgeting. Capital budgeting decision. So again, if I ask a question on the same one, right? So what sort of investment this is? Is that invest in real assets or the financial assets? This investment is on real assets or financial assets? Very good. That is real assets. Real assets. Okay. Then we'll move to the third one. Right? Third one. BYD company decided to maintain an inventory level worth of 100,000. Inventory. What sort of a decision this is? Very good. That is working capital management decision. If you heard the word inventory, creditors, debtors, and then the other one, cash, that is goes to where? To the working capital management decision. Working capital management. Working capital management decision. Working capital management decision. Good morning, Saki. Then we'll move to the fourth one. Sunil company has declared 1 per share dividends, right? 1 per share dividends to the existing shareholders. What sort of a decision this is? Very good. That is dividend decision. Dividend decision. Dividend decision. Moving to the fifth one. Right? Moving to the fifth one. Gamma PLC has decided to expand the business by entering to the new market. By entering to the new market. What sort of a decision this is? Exactly. This is investment decision. Investment decision. Good. Right. Then last one, right? Last one, sixth one. BBC company has decided to extend 60 days credits to their customers, right? Credit to their customers. Customers, debtors, inventory, cash. What sort of a decision? Working capital management decision. Working capital management decision. Working capital management decision. Working capital management decision. So this is how we can classify the given 6 activities into the main decisions, right? Accordingly, we have identified how many decisions? 4 decisions. What those are? Starting from financing or capital structure decision. Second one, working capital management decision. Third one, dividend decision, or the other one, investment decision, right? So these are the things that actually what we are going to learn after the 6th lesson onwards, right? Main 4 decisions. Right. Hope this is okay with the online students also. Right. Next, we'll move to the financial manager in the hierarchical order of the company, right? So some of you might work in the companies, right? In the finance department. Raise your hands if you are working in the finance department. Very good, right? All of you are working at the finance department. So then, no need to explain this one. Can anyone explain the hierarchy of your organization, finance department hierarchy of your organization? Yes. Can someone explain about the hierarchy of your organization, finance department hierarchy? Faces. There is a key. You have new faces, right? New faces. Oh. What's your name? Tattoo. You were expecting the last week. Why? Okay. Yes. You can explain to me. At least you are normally started with the interns, right? The lower level is the interns. Or sometimes they are going to be trainings. Right. What else? And then trainees to executives. Then executives to senior executives. Senior executives to assistant finance manager. Then finance manager. Then finance manager reports to who? CFO, Chief Financial Officer. Okay, so if you want, you can watch these two videos, YouTube videos, to have a real picture of the finance manager. This is what we need to mainly focus on, right? And same as the other subjects, finance also having a history, right? Finance also having a history. This history can be divided into two decades, right? So first one is 1950s, before 1950s, then the other one is after 1950s, right? So before 1950, when this subjects actually finance is coming under which discipline? Yes, finance is coming under which discipline? Yes. Cash management. Discipline means we have the phone, we have the cars, we have the management, likewise we have main discipline. So finance is coming under which discipline? It is the right. It's discipline. Accounting is actually within the finance, accounting is small part, right? Preparation of the financial statement and all. Finance is broader concept than the accounting, that is why head of finance is the CFO. Otherwise, that can be the accountant, but this one, it having the position of the CFO, right? Four. Control. So the base for the finance is economics, right? Econometrics for the core background, within the economic background, the finance subject has been arised because when we are dealing with the monetary activities of countries, individual corporations, householders, and all the things, the finance concept has been given. So therefore, broad concept, broad discipline, subject discipline is the econometrics or economics, right? Okay. Anyway, when this subject evolves, right, before 1950, that has been identified with a narrow down concept. Just they have think about finance means what? Acquiring the funds only. Right? Acquiring the funds only. In that era, companies focus on what? Companies focus on maximizing which one? Profit. Right? Finance objective is maximizing profit on. And later on, after 1950s, with the Second World War and all the things, what happened? This subject has been expanded, right? Now they think after 1950s, they have considered now this subject not only acquiring funds from the outside, but also utilizing these funds in business operations, generation of profits, and sharing the dividends, as well as sharing some part of profit to the existing shareholders, not only that one, making the investment, right? So accordingly, they have come up with the objective of finance is as a wealth maximization of shareholders, not the profit maximization, right? So we have two approaches accordingly. Traditional approach as well as the modern approach, right? In the traditional approach, that means before 1950s, and then this is after 1950s. So they have just considered finance is what? Outside looking approach, right? Finance is an outside looking approach. Why? They have just identified raising funds, right? Raising funds. Financial management is one. Raising funds only, right? If we want to raise the funds, what we are looking for? We are looking the outside looking, right? outside of the company. Outside of the company. Accordingly, their main objective was profit maximization, always reducing the expenses and then increase the income. This was their main approach. But later on, right? But later on, they have identified not just only collecting funds from the outside, we have to consider, right? We have to consider 4 activities, right? 4 activities as discussed in the last week. We have to consider definitely how can we acquire the capital, which has been discussed in the previous approach also. Not only that, we have 3 main activities, right? Including the previous activity that was dividend, considering working capital management, and then considering the investments. Considering investments. Now you can see here, if you want to acquire the capital, company have to look at the outsourced people or the investors, potential investors. That is why previously they have called it as an outside looking approach. But, right, now in the modern approach, what they are considering is not outside, how the company also utilizing these funds. So therefore, we identify the modern approach inside as well as outside, both. Inside plus outside looking, right? With this inside and outside plus looking, their main objective was shareholders wealth maximization, right? Shareholders wealth maximization. Accordingly, in modern era, we identified the firms, right? Firms financial management goal is what? Maximizing shareholders wealth, not the profit maximization, right? Financial management main goal is what? What is the main goal? Shareholders wealth maximization. Maximizing shareholders wealth. Hope it is okay. Can I move to the next slide? You can highlight this one. When it comes to finance subject, you have to have a highlighter, straight pens, and other things. When I told you to highlight, please, you can highlight because that's the important part. That's why I'm asking to highlight. So therefore, please highlight, take a highlighter and highlight. The finance management main goal is maximizing shareholders' wealth. Hereinafter, we are going to have a discussion on how can we maximize wealth. That is the next session. Yesterday, discussing in the last week. I think we are with maximization. Last. Okay. Right. So then we identified, right, with coming to the, within line to the traditional approach, right, within line to the traditional approach, their objective before 1950s, their approach was to have the maximized profit. But, right, after 1950s, they have considered not only the profit maximization is a role of the finance manager, he have to concern on shareholders, not the company inside. Profit maximization means is that perspective of the company, within the company or outside approach. Profit maximization means inside approach, right? They just want to have the increased profit. But after 1950s, they have identified we have not only considered from the inside perspective, the real owners of the business. Who the real owners of the business? Business means now we have normally considered the PLCs, right? PLCs. Who are the real owners of the PLCs? Shareholders. What sort of shareholders? We have two shareholders, ordinary shareholders, and the other one, preference shareholders, right? Who are the real owners? Ordinary shareholders, or we call them as equity shareholders, right? Equity shareholders. So then the finance manager, they thought, right? So in this, after 1950s, we have to consider the shareholders because why? They are the real owners, right? They are the real owners. Real owners. So then, what is mean by wealth and maximization is okay, wealth. Right? If we want to contribute for the shareholders, if we want to think about the shareholders as a company, how can we give a benefit for them? How can we give a benefit for them? I'm thinking. We want to give something to shareholders, our real owners of the business. Right? We want to give something up to shareholders because they are the real owners. We have to contribute for them. Right? In contributing for them, what can we do for them? How can we give a benefit for them? Actually, from the company perspective, what would be the contribution for them? Okay. Bonus, okay, dividends, what else? Dividends, what else? Exactly, right? By giving the dividends, right? By maximizing the profit, by making some lot of investments, right? What we can do is we can increase the market price of a share, right? For example, last week I have purchased 200 per share from the Sampat Bank, right? Per share is 200. But now this week, if I want to sell it, now it has become 250, right? 250. Accordingly, the shareholders can gain 50 rupee gain, right? So therefore, increasing the wealth, right? Increasing the shareholders' wealth means what? You have to increase. As the future financial managers, you always need to look at for what? In achieving this objective, you want to look at? Yes, what is it? Share price, right? Share price. Share price means technically we call it as a market price of a share, right? Market price of a share. Always company finance manager, by taking the better decisions, they want to think how can we increase our market price of a share. If the market price is going down, what happens? It reflects what? It reflects what? Company is not having a good financial position. Right. We'll read. The wealth created by the company through its action is reflected in market value of the company's share. Hence, wealth maximization right? Wealth maximization reflect maximizing what? Market value of its share, right? Market value of its share. If the company finance manager want to increase the shareholders' wealth, they have to increase the market value of a share continuously. Because why? The real equity, the real owners of the business is the equity shareholders. Equity shareholders, right? Equity shareholders, their ownership can be obtained via what? Can be obtained via what? Their entitlement towards a company. How can we measure them? The entitlement of the shareholders toward the company can be measured by the number of shares. So then equity shareholders entitlement can be measured via number of shares. Number of shares. Which shares? Ordinary shares. Ordinary share. So then we identified shareholders wealth maximization equals shareholders wealth maximization SWM equals number of ordinary shares. Number of ordinary shares, right? Multiplied by market value of a share, right? Market value of a share. You can highlight this formula and write down this formula if you do not have the handout, right? Wealth maximization equals number of shares multiplied by market value of a share. We have 33 students, right? 33 students. Oh, but then we have 33, 38. 60. Sorry, some of our Para seguir saber que normally this is average participation. Okay, right. Please write it down, right? Shareholders wealth maximization, right? Shareholders wealth maximization. Until you are writing down it. So I will go to our main diagram, main decisions. After main decisions, we identified shareholders wealth maximization. Last week, I asked you to keep a first page as to draw this, the short note, right? Shareholders wealth maximization. Shareholders wealth maximization. You can just write it down. Number of shares. This is for your short note. Number of shares, which shares? Ordinary shares multiplied by market value of the share. Market value of the share. Okay. What factors, just a question, right? What factors are you going to consider when you're purchasing the shares of a company? What factors investors looking for when they are purchasing a shares from a company? What factors? I will just give 1 minute. You all have to get a one factor and tell me, right? Just think one factor and tell me. I will give just 1 minute. What factors you are considering when you are purchasing the shares of a company? First one done. EPS. Good. What else? Financial position. Good. What else? Very good. MPS. Good. What else? Sakil? Market? Demand for shares. Okay. What else? Cash flow. Cash flow. What else? When you are trying to purchase a share from the share market, what sort of factors you are looking for? Financial statements. Financial statements means what? We are normal financial statements actually. We have to refer financial statements. By looking at the financial statement, normally we are looking the capital structure. Aren't we looking at the capital structure of the business? If you are a rational investor, what sort of debts, what sort of equity they have? We have to look at capital structure. Capital structure, right? Aren't we going for the debtor balances, creditor balances, and cash balances? We are looking for, right? So therefore, we have to look at financial position, or else debtors, debtor balance, creditors, cash balance, inventory balance. We have to look at, right? What else? Short-term loans and long-term loans. We have to look at financial structure, equity plus debt. What else? Yeah, it's an important aspect. We are looking at the vision, mission, and all the things, right? But aren't we looking at the investment proposals, sustainability aspects? There are future plans and all the things we look at, right? So investments, what sort of investment they have? Then we specially concern dividends. Very good. We specially concern, I will write it here, sorry for that one, dividend, right? Dividends. If we divide this first one, if you want to write it down, my handwritings are not that much clear. Dividends, earning per share, right? First one, dividend, earning per share. And then financial position. Financial position reflect debtors, creditors, cash, inventory. Debtors, creditors, cash, inventory. And then MPS. What is mean by MPS? Market price of a share. Right? MPS means market price of a share. Then cash flows. Cash flows. Cash flows. Then capital structure. Capital structure. Capital structure. Capital structure means, right, debt and equity. E means equity, D means debt. E means equity, D means debt. Then the other one, investments. 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 Next one, demand for the shares. Demand for the shares. Last one, vision, mission, and future plans. Future plans. Right. So then, if we divide these 10 activities into main two, right, we can identify there are some financial factors, right? Financial factors as well as non-financial factors, right? The first one, two, three, four, five, six, seven. First seven, right? What those are? Financial factors. Financial factors. Right? When the rational investor is going to have an investment, they are considering both financial factors as well as the other one. What is that? Non-financial factors. Non-financial factors. Financial factors as well as the non-financial factors. If we concern most critical part for us is the financial factors, right? If we concern about these financial factors, right, you can see here, right? Dividends, right? Investments, capital structure, right? And then debtors, creditors, inventory, cash management, and all the things. What they are considering about, they are considering about main four decisions, right? Those are in line with what? Right? Four financial decisions. Four financial decisions. That means, right? That means finance managers are looking at the four financial decisions. Other than that one, right, if I want to place the profit here, right? So when the company is calculating the profit, right? When the company is calculating EPS, earning per share, then they have to consider what? Profit. Profit. Other way around, we can identify it. Normally, rational investors are looking at the profit as well, right? Rational investors are looking at the profit. But if the company is thinking only about the profit, right? You can see here, profit is a small aspect of this entire factors we are looking at, right? Only one factor where the rational investors nowadays not only the concern about profit, they are concerned about the lot of factors, including financial as well as the non-financial. Right. So then we'll move to the next part. Now, if the company is performing good, if the company is running these four financial activities in a effectively and efficiently, what happened? Demand for the shares is going up or going down. If company, they have a good financial position, they have good cash flows, they have sharing the dividends properly with the growth rate. So what happened for the market price of a share? Increase. How it increase? The demand for the share is going up, right? Demand for the share. This is regarding a share, right? And then share and supply, demand and supply. How the market price of a share is determined based on the demand and supply of the share, right? So if the demand is going up, what happens? It's causing for the increasing the MPS, right? Always increasing the MPS within line to the supply. So then you can identify it, right? So company in effectively managing these four financial decisions, they can do what? It's directly impacting for what? Increase of the market price of a share. This is why I want to explain. Other one, right? If the market price of a share, sorry, if the market price of a share increase means, right? The other way around, what happened? Shareholders wealth maximization is happening, or shareholders wealth is going, shareholders wealth is going up. That means what? The four financial decisions are impacting for what? Impacting for the shareholders wealth. Right? That is one aspect I want to explain. The other way around, if I told you profit maximization, sorry, shareholders wealth maximization is broader than the profit maximization. Are you agree or not? Shareholders wealth maximization is a broader concept than the profit maximization. Do you agree or not? Agree. Why? When company increasing the shareholders' wealth, they have to consider the MPS, right? How the MPS is determined based on the demand and supply for the share, right? How the demand is determined based on the four financial decisions within line to the financial factors and non-financial factors, right? In the non-financial factors, one of the factor looking at the company's investors is what? Profit maximization, right? Profit maximization. That is mean EPS. If the company is having a high profit, their EPS is going up. That's only a one factor, right? Which is looking at the shareholders' wealth maximization. Therefore, we identify profit maximization is a which concept it compared to the shareholders' wealth maximization. Which one is broad one? Shareholders' wealth maximization is a broader concept than the profit maximization. You can write it down. Do I need to give a note for you? Write down the question, or else you can write down the question. Shareholders' wealth maximization. Shareholders' wealth maximization is a broad concept than profit maximization. Shareholders' wealth maximization is a broader concept than profit maximization. Full stop. Do you agree? Kind of the answer by your own. That do. Relatives. Yes, absolutely. How can you write? If you want, you can write. How can we write? If I have written down the answer, you can write. If you have written down the answer, you can proceed, right? How can we write? How can start? Shareholders wealth maximization is calculated. If you want, you can write. Huh? Shareholders wealth maximization calculated by multiplying number of shares and market price of a share and market price of a share. The market price of a share. The market price of a share. The market price of a share is determined based on the supply and demand. Supply and demand for a share. For a share. The demand of a share. The demand of a share is affected by financial factors as well as non-financial factors. Financial factors as well as non-financial factors. Full stop. Capital structure. Investments, dividends, structure, investment, dividends, creditors, debtors, inventory, cash management, some factors. EPS is like EPS. Gross profit, EPS and gross profit, EPS and EPS are some factors. Are some factors. Are some financial factors. Are some financial factors. These financial factors mainly can be categorized in four main financial decisions. The effective management of these. Effective management of these. Activities. Versus to high demand. High demand for a chef. High demand for a chef. Meanwhile, profit and EPS is very question. Are some factors which highlights highlight the importance of the profit. Highlights the importance of the profit. Importance of the profit to the demand of the share. Accordingly, we'll stop accordingly. Profit maximization. Profit maximization. It's a one important factor. In shareholders' wealth maximization. Shareholders' wealth maximization. And please write down this and highlight. Shareholders' wealth maximization is broader than the profit maximization. Conclude your answer with this. So the answer I think shareholders' wealth maximization is a broader than profit maximization. These conditions. Let's quickly do this activity also. Right? Just read the activity. Assume you have purchased 100,000 shares of HNB Bank from open market at rupees 181 each. You have provided or you are provided with the following additional information. Net asset value is 180 each and current market price is 191 each. What is your wealth? Right? In the finance, please read the question 3 times. Right? Please read the question 3 times as well as given case 3 times. This is a small question, therefore 3 times. But if it is a little bit complex question, you have to read it 3 times because otherwise you get the real picture of the question. But it asks, what is your wealth? Right? What is your wealth? What is your wealth? So then you have assumed how many shares you have purchased? 100 shares, 100,000 shares. And then from the open market, that is 181. If you want to identify the purchase price, how much is it? Purchase price equal, we have purchased, Patum purchased 100,000 shares by 181. What is the amount? 18,100,000. Then now you are trying to sell this one. Right? Sell this one. Or else the shareholder wealth, Patum's wealth. Right? Patum's wealth. How can we identify? Patum has 100,000 shares. Now he can sell this share for another 91. That means 19,100,000. What is the profit? Right? So this is wealth. Right? This is wealth. Shareholders' wealth. If we just want to have, before going beyond the question, we cannot have the profit. Profit by this transaction. How much is it? How much it is? 1 million. Right? 1 million. Why this is 1 million? Because you can identify even Patum acquired the shares by 181. Now this has become 191. Because why? Finance managers within the company, they have handled their financial activities effectively and efficiently. That is why the market prices are going up with the economic factors. Otherwise, the price going down. Right? So then this is called as what? Rather than calculating the profit, reducing the expenses and increasing the income, rather than doing that profit maximization, shareholders or the managers of the company, finance managers, the CFO, they have a huge duty on this one. Right? Because profit maximization is a small aspect, whereas managing all financial decisions is a bigger task than the profit maximization. Hope you have understood the concept properly. Are you clear on this? Wealth maximization? Okay. Okay, good. You can write down this answer if you want, or else you can do it by your own. Okay. We'll have a small break and come to discuss the agency theory and stewardship stakeholders, right? You can have teams, break and come up. Today we have two sessions. Normally you have lectures on Sunday. Sunday and Sunday. Sunday until 6. Yeah. Sorry. Right. Board of directors responsible for the shareholders. Right? Why the shareholders are appointing the board of directors? Because all the entire shareholders can't control the business. So therefore, out of the shareholders, there are 2-3 board of directors will be or directors appointed for the managing the business operations. Right. Anyway, anyhow, they are the real owners. They also have the entitlement toward the company. Right? If they are the owners, right? If they are the owners, what is their objective? They want to have a profit, right? They want to have a profit. So therefore, their objective is always profit maximization. Profit maximization of company. But board of directors can't control the business. So therefore, they can't manage. They do not have the proper guidelines. Sorry, they do not have a proper expertise on managing the business operation. So therefore, they hire. They are hiring, right? Managers. They are hiring the managers, right? Managers have the responsibility towards the board of directors. Managers, they have to report for the board of directors. They have to go for the board meetings, board minutes, the board meetings, and they have to read the proper guidelines and all the things they have to do. They are responsible, right? Always their activities to be reported for the board of directors. So then indirectly, anyway, now, right? When the company managed by the managers, right now shareholders pay some cost. Shareholders pay some cost for these managers. Pay cost. What sort of cost? It might be including, right, financial cost or the financial benefits. They have to give some benefits. Right? Or else from their perspective, shareholders are incurring some cost from the managers. They are expecting some benefit from the shareholders. So this benefit or cost might be including financial benefits, or the other one, non-financial benefits. And financial benefits. Indirectly, managers also, they have a duty towards the shareholders, but not directly responsible for the managers are not directly responsible for the shareholders, but they have some sort of duty or else they have to manage the activities toward the shareholders, right? So these are the 3 parties. Now you can see here there are 3 parties. It doesn't come. You can see here there are 3 parties who they are. Initial owners of the business, they are the real owners of the business, shareholders, and then appoint the board of directors. Since they are not expertise in the relevant field, so they are appointing the managers towards the business activities. So what the managers are doing is they are engaged with the engage in business activities. They are engaged with the business activities. What is their actually objectives? Once you become a top manager, what is your objective? Do you want to profit maximize? Do you want to have profit maximization? No. What is you expect? What is you expect normally? That's a real picture. By becoming a manager, what do you expect? You want to contribute for the company? No. What is your real objective? Yes. To have a good salary. To have a good salary normally as a manager, not being a part of the company, not being a real owners of the company. Do you want to actually maximize the profit of the company? No, that's not your intention. Right? That is your duty. But your intention is something else. You want to always have what? High salary. Right? So then, their personal well-being, right? Their personal well-being. They're expecting their personal well-being. High salaries, high financial benefits, and non-financial benefits even. Clear? Now you can see here, instead of the real owners, those who are controlling the business activities do not have a same intention. Right? Managers, they want to have their well-being. But the board of directors, they always want to have what? Want to have the high profit. So now you can see here, there is a disparity in between their objectives. They are not similar. Right? They are not similar. Now we'll identify who are the real owners of the business? Shareholders. Right? They are the owners. They are the owners. Who is the agent here? Agent here on behalf of the shareholders who is actually engaged with the business activities? Managers through the board of directors, that is manager. So therefore, these managers act as whom? They are the agents of the shareholders. They are agents. They are agents. Right? They are the agents and they are the owners of the business. Agents are not the owners. There is a deviation in the owners. So owners are real owners, those who have the entitlement, but the agents are what they are doing. They are active, they are maintaining or they are doing engaged with the operational activities on behalf of these owners. Right? Clear? So since we want to, there is now what happened? Agent board of directors hire the managers or the agents, right? So actually there is a what? When they are dealing with activities, they have a relationship also. Otherwise they can't work together, no? Right? So this relationship, we call it as what? Agency relationship. Agency relationship. Agency relationship. To maintain this agency relationship, right? So companies have to, shareholders have to pay some cost on behalf of these agents, right? Now they are acting on, they are actively faithful minds and then they are engaged in the business activities properly. But sometime what's happened? When these two parties' objectives are not similar, what happened? It leads for what? It leads for an agency problem. Agency problem. Agency problem. Right? Hope it is clear. So then to mitigate again agency problem, again shareholders have to maintain a proper relationship with these managers. That means pay what? Pay the agency cost. Agency cost. Right? Agency cost. What the agency cost include? Non-financial benefits as well as financial benefits. What are the non-financial benefits? Medical bills, sometime trips, selecting the best employee, right? Giving certificate, giving recognition. Those are coming under the non-financial benefits. What are the financial benefits? Salary, then OT, then bonus. What else? Medical bills, the medical bills, but those are financial benefits, right? To maintain the proper relationship as well as to avoid the agency conflict in between these two parties, shareholders have to give the proper agency cost for these agents or the managers. This is what we called as the agency theory, which is a base for the establishment or the creation of the finance concepts, corporate governance. So this is coming basically under this entire picture is coming to the corporate governance, right? Corporate governance. Corporate governance. Right. Okay. So this is actually why we have to identify the finance also, right? Finance also. Because the agents are doing, agents means managers, CFO, finance managers, all the finance teams are acting here, can be placed here. Even for the same diagram, I have given the yeah. Shareholders, you can write down three parties: shareholders, board of directors, and managers. Won't have it again. Shareholders, board of directors, and then the managers. Managers means below that one, write it down, agents, right? Agents. So then name these two parties. They are the owners. Owners. Two parties, owners. Okay, right. So then we'll come to shareholders, appoint board of directors. Appoint board of directors, and then board of directors responsible. Responsible. Right? Board of directors responsible. So then board of directors hire. Right? Board of directors hire managers. Managers responsible for board of directors. Responsible. This word is responsible. Okay. Below the board of directors, write it down. Their objective. If you want, you can highlight. This is objective, right? Board of directors objective is profit maximization. Board of directors objective is profit maximization. Managers, what their role is, they engage in business operations, right? Managers, they engage in business operations or activities. Business operations or activities. The manager's objective is, right, again, manager's objective is their personal well-being. Managers' objective is their personal well-being. Personal well-being. Okay. So then managers will be paid by the shareholders. That means pay cost or benefit from shareholders to managers, right? Pay cost or benefits. Provide shareholders, provide benefits for the managers. So then managers also, they have a duty towards the shareholders. Duty towards shareholders. This cost include financial benefits as well as non-financial benefit. This is non-financial benefit and these are financial benefits. Non-financial benefits and financial benefits. Financial benefits include salary, OT, bonus and medical bills, etc. Salary, OT, bonus, medical bills, etc. Please write it down. These are what these financial benefits and non-financial benefits. We call them as what? Agency cost. Agency cost. Agency cost. The relationship between BOD and managers, we call that as an agency relationship. Agency relationship. If these two objectives of the board of directors as well as the managers are not same, that will lead to agency problem. Agency problem. I have written 3 phrases with black color pen so then you can highlight what those are. Agency cost, agency problem, and the other one, agency relationship. Agency relationship. That is what you want to have this from. That is what you want to have from this diagram. Agency problem, agency theory, and then the agency cost. All right. Hope it is clear. So then we'll move to the next one. Last one. Stakeholder theory. You know this one. Basic management, right? Basic management, what is it? Stakeholder theory. Agency theory. The other one, last part of our lesson, stakeholder theory. Stakeholder theory and agency theory. Shareholders, BOD, and then managers. Right. Then stakeholder theory. Who is the stakeholder? The interested party towards the business, we call them as what? Stakeholders. Right? Stakeholders are not the shareholders. Right? Shareholders means real owners of the business. But stakeholders means who they are? The interested parties, right? Interested parties toward the business, we call them as a stakeholders, right? So stakeholders can be internal stakeholders as well as the external stakeholders. Who are the internal stakeholders? Employees, managers, owners. They have the real interest toward the business activities because they get salaries and they are going to have the dividends and they are going to have the bonus, financial as well as the non-financial benefits. Then company, definitely towards the company there are some external stakeholders also. Who are the external stakeholders? Suppliers, debtors, creditors, and then government, and then tax authorities and all the things. Who else? Yes, who else? All the things. Society and etc. Right? They also looking at what? Looking at these respective PLCs, how they are dealing with investors, potential investors. They are always looking at this company performance and company business activities. Right? As the finance manager, so these are the external stakeholders and these are the internal stakeholders, basically, right? So then finance manager who is acting here, they have to consider, why they have to consider about the stakeholder theory. Stakeholder theory, why the finance manager need to concern on the stakeholder? Because why? Every financial decision taken by the finance manager definitely affected not only the internal but also the external stakeholders also, right? For example, NPV good, right? NPV positive, we accept the project. But if that is a harmful project for the society, definitely what happens? Society will against the project and then there might be a issues, there might be public issues, and what happened? That public issues might be causing for what? Decreasement of the market price of the share. Clear? So since the stakeholders are always looking at whether it is internal or external, looking at the business perspective, every decision taken by the finance manager is determined by these stakeholders and will impact for the market price of a share. Definitely MPS is impacted, means what happened? Share price is going down, shareholders' wealth is going down. So therefore, finance manager need to concern on both internal as well as the external stakeholders. Right. So then, if we come to our conclusion regarding this first lesson, what we have started, what we have identified, starting from the introduction to finance, that's the first part. And then we identified the areas in finance. And then what are the areas in finance? We'll identify quickly just to conclude our lesson. Main areas. What are the main areas? Investments. Investments and then financial institutes. Financial institutes and then public finance. Public finance and then entrepreneurial finance. Entrepreneurial finance. What else? Corporate finance. Corporate finance and then personal finance. What else? International finance. International finance. Right. So main 4 decisions in finance. 4 activities we identified. Duties of the finance manager. Duties of finance manager FM in line with the duties of there are 4 activities in line with the decision. Sorry, in line with the duties, we have the 4 decisions. 4 decisions. And then today we started with the shareholders wealth maximization. Shareholders wealth maximization means number of shares multiplied by the market value of the market price of the share. And then we discuss how the share, how the profit maximization is linked with the shareholders wealth maximization. And then lastly, we go through the agency theory as well as the stakeholder theory. Stakeholder theory means internal as well as external. Internal stakeholders and then external stakeholders. So then that means 3, 4, 5 and 6 items to be memorized for your exams and all things. Hope it is clear. If you have any question on these identified things, you can go through these reference materials and then you can look at the chapter that I have given in the LMS. Right? Only one person I saw. He has obtained all the copies of the uploaded chapters to the LMS. That's anyway good, right? So you can have the copies, all the copies, and have a booklet. Right? Because that is similar to the IM Pandey's reference book. Right? Any question on the first lesson? Any questions on the first lesson? First තියෙනවද? තේරුම් නැති තියෙනවද? Okay. So then we'll go to the second lesson. Yeah. Do we have time? I'm not going to discuss about the financial system within the class. I will give the assignment on that one, financial system in Sri Lanka. Therefore, we'll go to the third lesson, that is discussing about the time value of money, right? Time value of money. Anyway, have you heard that one in the? Have you heard the time value of money calculations? Have you do these things? Time value of money? කරාද ඔයාලා? නැත්නම් future value calculation, present value calculation completed. Taki. Completed. No. Have you heard that part? Time value of money? From where? Yeah, except. Yeah, except. Have you heard this one except or the before except? Have you discussed this concept in mathematics subject? You have mathematics subject, right? No. Mathematics and Galle. Statistics. Statistics තමයි තියෙන mathematics of ගැන discuss කරගන්න. Time value of money has not been discussed during the curriculum so far. Am I clear? That means we have to discuss it. If we have discussed, please tell me. Otherwise, we don't need to waste time. Okay. Anyway, even you have not discussed what you know about the time value of money, you can make ready time value of money. PVM. Time value of money. Now, here in after we are going to start the theories. Not the theories, but the calculations. Time value of money, keep the first page as blank and then go to the second page and start your workings. Because we need the first page to draw the diagrams. Okay, time value of money. Time value of money. Okay. Time value of money. What do you know about time value of money? Actually, we want to discuss basic ideas regarding time value of money. These are our learning outcomes. We have to identify how can the time value of money come in under the simple interest as well as the compounded interest and then loan amortization. These are the main targets of the lesson number 3. We have 4 learning outcomes to be discussed. Right. So I will start the lesson with a question. Right? Read the question. What is the question? A rupee today has a more value than the rupee after 10 years from now. Do you agree or not? What are your answers? This is not referring about the economic terms, economic value. Right? A rupee today has a more value than a rupee after 10 years from now. Do you agree or disagree? Agree. Agree. Why you agree? I'm not referring about the purchasing power and all things. I'm just referring the value, the numerical values. A rupee today has a more value than the rupee after 10 years from now. How many of you agree for this particular statement? Raise your hands if you agree with this. 1, 2, 3, 4, 5, 6, 7. All of you agree. Good. Anyway, we'll sort out the question in the middle of this lesson. We have the answer. That means this is referring the present value and then the future value. What this refer actually? Future value of the 1 rupee after 10 years from now. You have to compare the future value and then the present value. You are referring definitely future value is lower than the present value. That is what it says. Okay, what is it says? This is actually what says the future, the present value today. PV, right? PV means normally PV refers to what? Present value. Present value. What is it, Patum? Present value. So then, Patum, what is mean by FV? Future value. Anyway, I was unable to ask where are you? You are near to Colombo. Where are you from? One. Here. Is that your hometown? For boarding places? Future value. FV means future value. What it says is a rupee today has a more value than the future value. That is, it says anyway we'll identify which one is highest when we are coming to the calculation. So you all are agree with this one. Huh? What it says, you agree with future value. Present value is higher than the future value. 10 years after now means what is it? That is future value. Today means a rupee today means PV of a 1 rupee. This is discussing about PV of a 1 rupee today and then FP of that 1 rupee after 10 years. Okay, we'll go to the lesson. Okay, what is mean by time value of money? Over of time periods, right? What happened to the value of money? It's changing, right? You can identify after 10 years back how much of amount you can purchase by using the 100,000 or the 1,000. But it can't be right now. Neither. If you go to the shop, right? The particular, if you want to go to the PNS, recently you visited them or during your break. So then PNS, before 10 years back, if you go to the PNS with the 1,000 rupee, and how many items you can buy. Now, after 10 years back, right? So at the current moment, if you go to the PNS with thousands of 100,000 or the whatever the 1,000, right? Now, how many items you can buy? What happened? Value is changing, right? Value is changing. So therefore, always we'll identify a rupee in hand today is worth more than the rupee in promises at the sometime in the future. This is discussing about the worth, right? Worth is different than value, right? Worth is having high capacity at present than the future. Anyway, always the finance manager need to deal with activities which engage with the cash flows, right? So he's not always taking the financial decisions, and right now some financial decisions may create some future cash flows also, right? During these future times, past times, present times, what happened? The money value is changing. So therefore, always you have to remember this is a basic concept in finance, time value of money. Especially in the decision making, you have to consider the time value of money. That's why always, if you remember, you were given the discount rate. Some question papers you have faced even might be the corporate level or the subject level or business level CA or the AT or CIMA or whatever the thing, you might given at the end of the question, the discount rate, the inflation rate, the interest rate is like this. Why? To identify what? Time value of money. Even you have heard this one, time value of money, technically you don't know it. You have applied this one previously. Also, I'm pretty sure that since you are coming from the corporate background. Okay. People like to keep money in their hand because of three reasons. What those three basic reasons? For the consumption as well as for the savings and then for the investment. So normally you also keep the money in your hand because of why? You want to have the today you are normally you are earning fund. You are earning some sort of a money for the month. No, it might be 100,000 minimally, right? So then out of these 100,000, how much of amount you are going to deposit in the bank? How much you are depositing at the bank per month? How much you? Narayan. You are not going to save anything. These days, no. That means you are fully investing or you are consuming. Consuming. So how much? Bank savings. No. Anyway, sometime you might, if it is a minimum 100,000, at least how much you need to invest or how much you need to save. 25,000 at least. Yes. Look at that statement. හතරෙන් එකක් මොකද කරන්න ඕන? හතරට බෙදලානේ වියදම් කරන්න කියලා කියනවානේ හතර. මොනවාද හතර? සේව් කරන්න ඕනේ. පරිවර්තනය කරන්න ඕනේ එකම. Investments. Assumption है. But get the reporter नहीं. Assumption. आपने क्या कितना करना बोले? And then you can see. Anyway, normally if you are earning 100,000, how much you need to save? Only 25,000. Savings and investment, two different aspects. Are you agree with me now? Savings is you just without having expectation, you just save. But investment is something else. You have a future, you are expecting a future benefits, and then you have to please definitely for a long run period with the expectation of future benefits. Right? Investment means you might invest in the pension plans, you might have the insurance plans and all things. Sometimes you might invest in the share market, sometimes you purchase a car, you purchase a land. So what those are investments. Therefore, individuals, they like to keep their money within their hand because of the future investment, for the future investments. Savings is something else. Once we save money and then after long run period, we can have a huge money. So then that might be applied for the investment. So that is how we goes up. So therefore, there is a deviation in between savings as well as the investment. Other reason is for the daily consumption, for the daily operations, daily activities. You are keeping money out of the earnings. Part of the earnings goes for the consumption also. Right. So what is the importance of, right, time value of money concept in corporate finance or finance? What are the reasons? What previously I told that one to you. Anyway, what is actually, why do we need to consider about the time value of money? As the CFO, so you are going to become a CFO, like chartered accountants, your target should be the becoming a FM or CFO. Right? Why should you consider the time value of money? Yes. Why should us we have to consider the time value of money? Exactly, right? So when CFO, you take our example, this is Pato, right? CFO, JKH, John Gates. You are going to have a big position, right, Pata? So I'm pretty sure that you all been you will be the example for my each and every lesson because I also have a friend of Patu. So then I can remember that name. Okay, Patu. JK CFO, right? So as the JKH finance manager, what are the main financial activities the Patum have to engage with? Capital structure decision. And then investment decision. You can write it with me, investment decision, capital structure decision, investment decision, dividend decision, and the last one, that is it. That is working capital management decision. Right? So when the finance manager engage these activities, right? When the finance manager engage with these 4 activities, right? They have to he or he have to consider what? Cash flows. Cash flows. Cash flows. These all 4 activities engage with the cash flows. Which cash flows? Cash outflows as well as cash inflows. Outflows, that means minus, and then the other one, inflows. These cash flows, right? All the cash flows are not occurred at present context, right? So therefore, definitely these outflows and inflows might be occurred in future and present, right? These cash flows occurred sometime future, sometime present. Right. For example, you all know, if you go to analyze the investment decision, right? Investment decision. Example. Right? Example. If you are going to make the investment decision, you have a new project to go with. So then you have calculated NPV. How can you calculate the NPV? Because that project, right? The assigned project, not only incurring the cash outflow at present context, it identified what? Future cash flows. Right? Future cash flows. If you remember, when you are calculating the NPV for the project, you have to identify the current cash flows, either cash outlay as well as the future cash inflows. So sometime that might be outflows. Again, if I explain, you are going to purchase a building. You are going to purchase a new project, right? Machine, estimating machine. The current funds that you have to commit is 1 million, right? The useful lifetime of this project machine is 5 million. During the 5 years, 5 years. So during the 5 years period, right? It will generate annually 1 million cash flow, 2 million cash flows. Now these cash flows are not present cash flows. Out of these, identify two type of cash flow. That means outlay, initial cash outlay 1 million, and then the future cash inflows. You have to identify present cash flow is how much? 1 million. Future cash flows 2 years or else for 1 year, 2 million cash flows. That means what those are? Future cash flows. Right? Future cash flows. That is regarding only the NPV, right? NPV valuation. If we come to the working capital management decision, again what happened? Okay. Very small example, equity. You are going to pay you are going to obtain you have issued the corporate bonds. Right? Corporate bonds means it's a contract. Right? It's a contract similar to the loan. But there are some deviations. Right? So when it's come to the corporate bond calculation, that cash flows, you have initially collected cash flows, but that cash flow needed to be settled after 5 years. Right? That means after when you are settling this cash flow, collected cash from these bond providers, bond holders, bond cash flow providers, you have to consider what? High value of money. Because why? You pay this cash flow, collected cash flow after 5 years. Right? The basic you have to understand here is each and every 4 decisions, right, deal with cash flows. It might be outflows, it might be cash inflows, right? Definitely, these cash flow might be occurred at present context. Some of cash flows occurred at present, right? But some of cash flows indicate future cash flows, right? Future cash flows. If you consider if you given the future cash flows, right? Can you take as it is? Can you take as it is? No, you can't. Why? Today value is different than the future value. Right? What you have to do is you have to convert that future cash flows into the present context since you are taking the decision at present context. Am I clear? Right? So then in converting that future cash flows into present, what you have to use? Time value. Right? So this is why the finance manager need to concern about the time value of money. Are you clear? Good. You can note down and then we will the first session. CFO, John Keynes, and then these are the decision, capital structure decision, investment decision, dividend decision, working capital management decision. Each and every cash flows, each and every decisions are linked with the handling of the cash flows, outflows and inflows. These outflows might be occurred at future as well as present. So when they is taking the decision by using the future cash flows, they have to consider one TVM, time value of money. Example, if you want, you can write it here, factoring more than 1 year. Working capital management decision also involving the time value of money, example, factoring and all the things. And then capital structure decision also involving the time value of money. For example, corporate bond valuation. Corporate bond valuation. Yes. Occurred at future present. Or that future present. Okay. Anyway, I was unable to wish you happy Valentine's. Charityanadi Valentine's. Is it working? Okay. You can leave once you have marked the attendance. Thank you very much. We'll meet at 12. 12 to 3 hours of my lecture, right? We'll do the calculations. Anyone who are unable to mark the attendance? Mark the attendance. Okay, tell me that. In next numbers, I will mark it. Don't worry. Okay. 26, 22, 2, 13, 12, 9, 31, 24, 25, 10, 20, 17, what's your 29. What's your number 3? 29. Okay. Ramanayaka. Number 3 the putta. It's mark. Nimeshi. Any other one who are unable to mark the attendance? No. Okay. Right. So